Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. On a lot of my episodes previously, I've discussed personal income tax and estate and gift tax, but today we're going to shift gears a little bit. We're going to look more at some corporate and partnership tax principles as we talk about basis step-up in the realm of entity ownership at death. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, in a previous episode, we talked about the step-up in basis that is available for appreciated assets owned by a decedent at death, or which are treated as owned by the decedent at death. And just as a reminder, when I say treated as owned, what I mean is that the asset is included in the decedent's gross estate for estate tax purposes through any one of a variety of means, like retained use or control of an asset that's been irrevocably transferred by the decedent, or the decedent holding a general power of appointment, or a Q-tip election having been made with respect to property owned by the decedent at death. Now, shifting gears back to the substance of our discussion today, it's often the case that business entities can make up a large part of the taxable estate. But there's two basis considerations that come into play with any sort of ownership in business entity. One, there's the basis of the owner's equity interest, which is called the outside basis. And then there's also the basis of assets held by the entity itself, and that's often known as inside basis. Now, upon a decedent's death, the basis step-up only applies to the outside basis in the decedent's equity interest. So, the only way that the decedent's estate or any recipient of that stepped-up interest can benefit is if that interest is subsequently sold. But a buyer would want to know this, and also the other partners may also want to know this as well, or the other equity holders. Can you also step up the inside basis of assets? The answer is sometimes yes, sometimes no, but it depends on two factors. One is the type of the entity involved, and the other is the type of asset involved. Now, if the basis increase cannot be shifted inside, then the ultimate effect is one of timing. The entity must be liquidated ultimately in order to allocate any step up in outside basis to a entity ownership interest onto the inside basis of the assets owned by that entity prior to liquidation. Now, for partnerships, this is easy. So entities that are taxed as partnerships, which can include state law partnerships and also limited liability companies, LLCs. In the case of any entity like this, the outside basis step-up can generate an inside basis step-up, but it's not automatic. This is accomplished through a 754 election, which the partnership can make with respect to the stepped-up ownership interest in the partnership. Now, there's some limitations to this. One is that the basis adjustment has to apply to all assets other than hot assets, as we're going to see. So there could potentially be a step down in basis for some depreciated assets in the partnership. And also, hot assets do not get a basis step up, as I mentioned. Now, what are hot assets? Those are things like accounts receivable and inventory and depreciation recapture. A good way to think of hot assets is that they're similar to the concept of IRD, income in respect of a decedent, that we talked about previously in the basis step-up discussions, where any of the income generated by that asset is preserved for successor holders of that asset, if not specifically recognized by the partnership. Now, as I mentioned earlier, with the timing issue, you could also liquidate the partnership interest, but that has its own risk. Even though there's a step up in basis, any cash or debt relief that is in excess of the outside basis could generate gains still, especially debt relief. It's important to look at that when it comes to accounting at the partnership level for basis and capital accounts. Now, C corporations are their own separate beast. There is a double taxation feature to C corporations where any income to the corporation is essentially taxed to the corporation itself. And then when that post-tax income is distributed by the corporation to its shareholders, there's also a tax on that income, which is known as a dividend. Now, to preserve that double tax treatment, it becomes a situation where no asset can leave the corporation without being treated as if it is sold. So if there's any change in ownership of a corporate asset, that's treated as a sale of the asset that generates gain to the corporation that is taxed. Now, this isn't as big of a deal now under the Secure Act because there's a lower corporate tax, but it can still cause headaches because not only do you have that corporate level gain that's taxed, but if the property is actually distributed out to a shareholder, it'll be taxed as a dividend unless there's a narrow exception that applies where the property can be treated as if it's received in exchange for stock. Now, we're not going to get into that narrow exception just because that's more the exception than the norm. So some of you might be thinking, okay, what if I convert to an S corporation? Well, it's subject to the same issues as with a C corporation, except that the S corporation is a pass-through entity. So typically, any recognized corporate gain that would be generated by an asset in the S corporation changing ownership to anybody other than the corporation will be that the gain increases the outside basis of each shareholder. Now, this can be a benefit, but it's also important to note that if the S corporation has ever been a C corporation, then you have a 5-year built-in gain period where any asset that changes ownership could be subject to an entity level built-in gain tax, which would completely, axe the benefit of this strategy that we're about to look at. But you could potentially harvest the outside basis in S corporation shares and shift those to the inside basis of assets without incurring taxable gain, at least to the shareholder who has the stepped up basis stock. And the way you do that is by liquidating the S corporation. So the effect is that the already stepped up basis is increased over the fair market value of the asset distributed because you have to allocate the recognized gain to that basis. And when that overvalued stock is exchanged for the asset, you then have an offsetting tax loss. Now, this doesn't always work perfectly, and unless the deceased shareholder owned 100% of the stock, then you're going to ultimately have some corporate gain for the other shareholders who do not own stepped up basis stock. So this is fraught with peril, but it at least gives a little more of an exit option than you'd have with a C corporation. Now, there's no way I can do this subject justice in this brief time, but it's an interesting concept to look at, and there's lots of other avenues we can discuss, which I'll leave for later episodes. And in the meantime, if you have any other questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thanks again for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.